Hey, everybody, welcome back to another episode of Cash Flow Positive. I'm your host, Kenny Bedwell, and we're going to be talking about if $250,000 fell from the sky and you had to invest in a short-term rental, where should you go? What should you buy? How would you do it? So I'm going to give you my advice and my tips on how to approach this. Now, keep in mind, the number one thing I want you to remember that not everyone's situation is going to be exactly the same. Okay, so I might be giving some general advice and it might not necessarily apply to you for a number of reasons. Maybe your timeline urgency, location, personal preferences, ROI goals can all differ. And that really impacts where and how we should invest. If you listen to the podcast, you might understand that. If you're new to the podcast, welcome. By the way, guys, thank you so much for listening to this podcast. I just want to give a shout out to everybody listening to this. Now I know it's not just my mother who's listening. There's other people listening. We made the top 30 in the entrepreneur category in Apple podcast charts. So, however Apple rates their podcasts, ranks their podcasts, we're in the top 30. That's awesome. And then top 85 for business podcasts in the United States. This is also on Apple or iTunes. So that's huge. In fact, this is really wild for me. I kind of got the chills when I saw this. Just like give credit to Dave Ramsey, but one of Dave Ramsey's podcasts is like ranked 35 and mine's 30. So huge accomplishment to be ranked higher than a Dave Ramsey podcast. So anyway, thank you so much for listening. That means the world to me that you guys are listening enough to give that, to help me get whatever boost and to rank higher. And be sure to share the podcast with a friend. Okay, let's jump into it. So if I'm speaking to someone who has $250,000 to invest, the first thing we have to talk about is your financing. So, and this goes for me too. If I was given $250,000, how would I approach this? I'm going to make a phone call to my lender. All right. I need to know what I'm approved for. Okay. And there's different type of approvals. We've been dealing with this issue recently with some clients where they are pre-approved using a 20% down loan. Now it could be 20% down conventional or DSCR, which is a commercial type of loan, but they're not approved for 10% down. But they think that they can do a 10% down because they're approved for 20% down, but they're not the same things. So number one, if you think you're going to use a 10% down loan and your pre-approval says 20% down, you need to go get a separate pre-approval for the 10% down. There's more rules. It takes longer. Just go do it. Don't wait till you're under contract. Seen some deals be completely torpedoed and explode because we didn't get the right pre-approval. All right. So I'm going and talking to my lender and I'm going, hey, Mr. Lender, do I have, what are my options? Okay. Now myself, I am technically self-employed. I have a meager W-2 I'm not going to get approved for anything conventional. Well, I don't know. It depends on the tax. Depends on how the lender reads my tax returns, but most likely based on my last tax return total income number, I mean, they think I'm poor. The IRS thinks I'm poor and I don't make any money at all. Okay. And I'm going to keep it that way for tax savings. So I don't want to pay the government just so I can get better or lower down payment. But most of you are in a W-2 where lenders love W-2s. They feel like it's more consistent. They know what to expect. Therefore, they're more willing to lend and take on higher risk, which means they'll give you not necessarily could be better interest rate for sure, but also you have to put down less of a down payment, like 10% down. So I'm talking to my lender. I'm understanding what I can afford from a lending standpoint. But remember, I talk about this all the time. The 5 things that go into every STR investment are your down payment, your closing costs, your construction costs, your renovations or updates. Okay. So if you're flipping a kitchen or bathrooms or paint or wall or whatever, we're going to have to do some of that stuff in a property. Number 4 is your furnishings and number 5 is your amenities. So let's go through that again. Down payment, closing costs, construction costs, design decor or furnishings, and amenities. So those 5 things combined make up what our $250,000 is going to have to go towards. So if I'm approved for 20% down only, okay, which probably going to be my case, then should I like a property at $1 million? That's $200,000 down plus closing costs. So I don't know, like $220,000. I'm really left with like $30,000. Is that enough for furnishings, design, amenities, and all that good stuff to have a really cool top property? No, because I want to buy a property that's going to be a top property. So the reality is my budget is focused, or my budget is dependent upon the cash on hand I have to invest. So with $250,000 with 20% down, I'm probably looking at a budget around maybe like 700. Now, another thing to keep in mind too is just because it's 700, like I like a range. So what am I comfortable going down to based on the probability that I can get a deal done that hits my ROI goals? And that's the second layer of it as well. So I also need to go in and go, okay, cool. If I invest $250,000, what am I expecting at the minimum for return to know that the deal was worth it? Because that key piece of information right there, this is important. Okay, a lot of people come to me and they're like, I don't know. Then I'm like, well, how do you know what the heck you want to buy, or if something's a good opportunity if you don't have a goal in mind, a minimum goal in mind, or just some level of like, hey, yeah, that checks the numbers box for me. So we need to know going in, like roughly at minimum, what do we want the return of the property to be? And I've done episodes on like the difference between cash on cash and cash flow. And that's exactly what I'm talking about. Do I have a cash on cash number, or is it more of a cash flow number? What's the minimum amount cash flow that I need for this property to be worth it? For me, and then cash on cash is how quickly you get your money back and what's the percentage. And that's usually what most people say. They're like, oh, I want 15% or 20% or 30% or whatever percent, right? It's a percent. For me, I'm really focused on cash flow. And I will find that the cash on cash return will follow the cash flow. So for me, I'm really looking at, if I had $250,000, realistically, I think, and once again, I'm making some assumptions here. Okay, it'd be a little bit different if I could put 10% down, but I know I'm gonna have to put a larger down payment. So I'm gonna have to put more down, which gives me less that I can use to invest into the property. So for 250K, I think personally, I'd be totally down with that property cash flowing at least $50,000. Okay, so if I do that, that gives me a cash on cash return of even percent of 20%. Okay, cool. So I can either say 20% or $50,000 off 250. So now I have roughly my budget, which is going to be around 700. I would say I would go as low as 500 if it was going to be like a burr or fixer upper project, maybe all the way on up to, because that would leave me about 150K to do some updates, on up to, assuming the property was maybe a newer construction or in just a really cool market, or, a newer construction in an area where there's not a lot of newer construction. I still need minimum 75K. So really that leaves me with 175. So I can do that and divide that by my down payment of 20%. I think 875 is pretty aggressive. I would say like 800 max is really going to be my top end of my budget, down to maybe 500. Okay, why a range? This is important as well. Remember this. We want to work with ranges because that helps us know, like that gives us flexibility. If we always work on the top end of our budget, we might miss something that was, slightly lower, like in the 550 range that could work. Okay, now the ranges could vary. Most people stick to a range of about 200,000. Some people 100,000, but the reality is, like, the wider the range and the more flexibility we have, the more options and the more deals that we'll potentially be able to see and evaluate. And that's exactly what I'm looking for. So I'm looking for a property between 500,000 and 800,000 that nets me at least $50,000 or a 20% return. Awesome. Okay, now the pieces are starting to come together. Now the next magical question are, based on all my personal preferences, what markets are going to fit based on what I want? Okay, now this is obviously personal, right? And so I'm going to be a little broad, and I'm going to say I don't care. I'm just going to be numbers focused. Most people do care. And when you think about it, like let me ask you this question. If you're sitting there going like, I don't care either, I just want the best returns. Would you invest in Alaska? Would you invest in California? Would you invest, think of really, really extreme places, whether it's political or distance or seasonality from like a weather standpoint? Would those impact any decision making? For 99% of people, yes, they would. And guess what? That's okay. But those are the types of things that help us know where we shouldn't look, and which leaves where we should look, right? So it's actually a process of elimination that helps us find the markets that we can invest in, not a process of how do I find new markets or how do I find markets to invest in. eliminate the bad markets first. And I say bad, like bad for you, not for everyone, bad for you. And that will leave you what's available are the markets you should look in. Okay, so for me, I'm going to pick like 5 random types of markets around the country. So I'm keeping it fairly broad and general that I know can work. But why 5? One of the biggest things I've learned in deal finding, I do this every day, all day. I do it a lot. Sometimes it's exhausting. Is the more specific we are with our regional or market preferences, and we'll clarify this in a second, but the more specific we are, meaning like narrowing it down to maybe 5 to 7, the better the results we're going to get. Because if you look everywhere, you don't have the mental capacity, or the mental bandwidth is probably a better way to say it, to know what a good deal is going to look like unless you know those areas already. Like you have a deal in that market, or but then you don't have deals everywhere, right? So it's like, when I'm looking across the country and I find myself like looking all around the country at the same time for this exact specific criteria, I don't really find anything. And the reason, it's not because there's nothing there, it's just, it's too broad. It's too general. So, but when I really hone in on certain markets, or I see properties that have certain attributes about them, i.e. moats, the things that separate them from everyone else, something unique, maybe it's views or location or water access or whatever it is, and I see that thing, I can then pick out and identify and figure out if that is a potentially good deal. But for most of us who don't have that kind of experience, it's really hard to do that across the board. And one of the biggest problems I see a lot of even my clients have is they'll see someone else buy something in a completely different market that they were just like unaware about. And they're like, wow, those numbers are crazy. Why aren't you sending me properties in that market? And it's like, well, we're really trying to get you comfortable with these markets so that you feel comfortable enough to actually offer on something. And so a lot of it is just like feeling comfortable, understanding where you can invest and what's going to make sense, but not like overdoing it. Like not like pulling out 20 markets and learning 20 markets. And when I say markets, I'm not talking about like tiny little areas. I'm talking about regions, right? Like the Smokies would be a market. Orlando, that would be Kissimmee, Davenport, Orlando. That whole area would be a market. The Emerald Coast, which makes up of like 30A, Panama City Beach, Destin, Gulf Shores, that is a market. That's huge. That's a really, really long market, right? I'm trying to think of like Scottsdale, Phoenix, that's a market. That's pretty big. I know it's just kind of like those areas, but there's, what I mean? There's like encompassing areas around there. When you think of the Smokies, it's not just Gatlinburg or Pigeon Forge. It's Gatlinburg, Pigeon Forge, Sevierville, Wears Valley, Townsend, like all those things make up the Smokies. That's the market, right? A market. We have the bandwidth for maybe up to 7 of those, and I really just say 5, to really understand what's going to work in that market. And that's going to help me know, number one, can I afford to be in the market? If I can't afford to be in the market, meaning if I go look in that market on Zillow or Redfin or whatever site I'm using, and there are no properties that fit my range of 500, 800,000, that's not an investable market for me. So let's go back a little bit. We dove in. Let's take a step back. We're picking markets. I'm going to pick a beach market, a mountain market. Oh boy, I put myself in trouble here. Shooting from the hip on this one. Let's do a lake market, a ski market, and a urban or maybe university market. No, let's do an urban market. Okay, so I'm going to pick 5 random markets. These markets are kind of from a hat, but they're good markets, okay? And it doesn't mean there's other markets out there that aren't better. It doesn't mean that you should be looking in these markets. They're just 5 markets that came to the top of my head that I know are good. There are plenty of other markets out there that are good that might fit these categories as well. I'm trying to be broad here. So beach market. Okay, that's going to be the hardest one. I'm thinking of my budget. Okay. And this is important too. So let me think out loud, because I think that's the valuable thing. I think that's what you guys kind of want to know, is how do I think about finding these markets as well? And how do I arrive to these conclusions? It's kind of a 2-parter. I know all these different markets out there, and I know what it takes to have a successful deal in those markets. Okay. So what that means is I'm not just like saying like, oh, I'm going to be in Gulf Shores. Well, crap, what do I have to do to be in Gulf Shores, Alabama to get $50,000 net? What's the purchase price going to have to be? Can I afford to be in that market? What type of amenities do I have to add to my property? Do I need to be at the top of the list? Is it a saturated market? All these different components go into this decision making. And so when I think about my situation at 250K, and so budget's going to be a big piece of this, the 500 to 800, okay, especially for a beach market. And then the second piece of it too is going to be what I have to spend to compete. And that's what's going to be really challenging about the beach market. So for example, let's pick out Bradenton. Okay. If I am, and that could be Bradenton, Sarasota, which is south of Tampa. It could be it might be the market I settle on because beach markets are really tough. Yeah, I'll settle on that one. So Bradenton, I have to, for the best properties that work in that market, and this is I go into STR Insights and I look at 2 bedrooms, 3 bedrooms, 4 bedrooms, 5 bedrooms, et cetera, and so on. Number one, what's revenue look like for the averages, 75th, 90th percentile, top performing properties? I'm shooting for top performing. So what are the average top performing properties making these markets bedroom count? Okay. So if I look at 2 bedrooms, they're probably around I don't know, maybe 70 to 80K. Well, I'm not going to net 50K from a 2 bedroom. All right. So then 3 bedrooms, they're probably doing I don't know, as high as maybe 140 best case scenario down to maybe 100. So, okay. And then I look at 4 bedrooms and I start to see a decent sized bump. There's some 4 bedrooms doing 180. All right. Well, that's pretty good. And then 5 bedrooms or some 5 bedrooms doing over 200. I'm being again, broad in general, but hopefully you're following along here. Now I go into Zillow Realtor and I go, can I even afford to be in this market? I know I can. That's why I said it out loud. But then what can I afford? Well, in Bradenton, I can afford 2s, but I know I'm not going to net my 50K off that. I can afford 3 bedrooms, and the max I can afford is really a 4 bedroom, and that's really where it's going to peak out at. It's going to be in the 700 to 800 range. Okay. But then the next question that you have to ask yourself, now that you know revenue, now that you know you can afford it from a purchase price standpoint, is what's the barrier of entry? So what do I mean by that barrier of entry? Barrier of entry is what are my costs to go into that market to be successful? Because I'm not going to shoot to be the average. Because if I am the average the next year, I'll probably make less money than I made the first year because the competition heats up, the amenities arm race, all these other things. So what do I need to do to compete and be the best in the market? In Bradenton, you got to have all the amenities. Obviously, a property with a pool, everyone has a pool, but heated pool, you've also got to have a pickleball court. You got to have the putt-putt. You got to have the fire pit. You got to have a game room, probably a theater room, and it's got to be well furnished and well designed and all this really good stuff. It's pretty competitive. Does it make it a bad market? No, I wouldn't have said it if it was. So I have to add those things, which means I need to have the capital to be able to invest in a market like Bradenton. All right. So if I buy an $800,000 property, which is the top end of my budget. Okay. So let's do some math on this. 800,000 times 20% from my down payment, I'm at 160. Okay. Let's just assume closing costs get wiped out on this one. 800,000, 160, that leaves me with what? $90,000 left. Is that enough for a pickleball court, furnishings, construction, any updates, anything like that? Maybe we're going to cut it really, really close. So it is maybe enough. So that market could work, but I better be looking for properties that are have 0 construction costs, 0 renovation costs. They better already be updated because I can't afford it based on my budget. Now, there are some other tactics where I can get seller credits to offset. We've talked about seller credits before. Remember, we don't want to go wild with that. We're not going for $100,000 in seller credits because that would be called mortgage fraud, but something to offset closing costs and maybe some improvements to the property, or it better just be an updated property already, right? So 160,000 max, that's at 800. That's the max side. Maybe I get something in the 700. It's a little bit less. All right. That saves, I think that's 140. So now I only need to do, now I have 110. That's a little more buying power to put in the pickleball to do all these things. But once again, property probably needs to be updated. Now I'm starting to create a buy box. That means I'm looking for properties that are already updated, ready to go from I'm not renovating the kitchen or the bathroom, not having to do floors, maybe some paint, some furnishings. Okay. But I need the pickleball court. I need, like, it's going to be like $20,000, $30,000. I need the putt putt. I need all these other things. It's going to add up quick. So to me, realistically, I'm probably looking at a 3-bedroom, like pimping out a really cool 3-bedroom so I can be in a price range a little bit lower, maybe in the 600 to 700 range rather than the 4-bedroom. But ideally, if I found a 4-bedroom ready to go, maybe it was already a short-term rental that has the space to add the pickleball court and the putt-putt and all that, I'm going for that one, right? So that's the approach, but I'm building out my buy box. I'm building out all this criteria to know, like, I see the data, meaning like I see that I need the pickleball court. I see I need these things. Therefore, on the other end, I have to find properties with my budget that equal this. So let's go to a mountain market now. So I've got Bradenton, Sarasota as one market that I'm interested in. So mountain markets. I'm going to pick Shenandoah. That's actually a really good one. So Shenandoah is going to fit my budget. It's actually going to be a little bit lower, maybe 500 to 600 range, 700 at the max. Okay. And we've had some really successful clients there. Next, what do we talk about? Barrier of entry. Well, do you need the pickleball courts? Do you need the putt-putt? Do you need the... No, you don't. You actually don't need any of that stuff. You do need hot tubs and maybe a barrel sauna, nice fire pit lighting, nice design. Sure, you might have to do some updates, but now I don't have to spend as much on amenities because that's not required in that market. When I say not required, I mean, it's more of an outdoorsy market, but there just aren't a lot of properties with those things. So I don't need to spend the money on those things just to compete. The barrier of entry is lower. So I can go in there and focus more on finding properties that are maybe need some more updates done to them because I don't need to go fork out, an arm and a leg on amenities. So now my buy box is slightly different for that Virginia Shenandoah market. What else did we say? We said a ski market. I think we said a lake market and like an urban market or college market or something like that. University market. So ski market. It's got to fit my budget. So I think I'm going to look in the, so I'm going to go low on the amenity need, meaning I don't need to spend too much on amenities, but I do need to spend more on updates. And I'm going to be looking in the, it's going to have to be in the Northeast, somewhere in the Northeast, like Conway, Wilmington. Killington's too expensive. Yeah, you guys are like, see how maybe Hunter, New York. I've seen some people pull some stuff off Hunter, New York, and probably need a little bit more capital, but I could maybe swing it there. 20% now is going to be tough. So anyway, you guys are hearing me like vomit out my thoughts on this, but I mean, all of these things are going into the decision-making on where I should look and what I should be looking for. The ski market's going to be relatively close to it. So the ski market's in the Northeast, similar to what I'm going to have to do in Shenandoah area, right? They're going to be less competitive from a barrier of entry standpoint. So I don't need all the amenities, but I am going to find older properties there, especially in the Northeast. A lot of them are really old. There's a lot of just like, window units where I want to do mini splits. There's a lot of properties that just need updating on the kitchens or the bathrooms. And that's where I'm going to invest my extra capital. Okay. I'm also going to have to go lower on the purchase price range to be able to have more capital to invest into the property. Let's do a lake market. I would honestly look, Michigan's really good. I'd look in Michigan. Now, be careful with the taxes, be careful with the tax reassessment, be careful with the regulations. But there's some really good opportunity in Michigan. Once again, I'm going in low barrier of entry markets. Okay, now I started with one that wasn't, just to show you that it's not necessarily you have to go into low barrier of entry markets. But I really like going in low barrier of entry markets because we don't have to just throw out hundreds and hundreds of thousands of dollars in design, decor, and amenities to compete. Okay. So I do like the Michigan lake markets, and I think there are really, really good opportunities there all around. Just watch out for regulations, and also the taxes will get you on the reassessments. But there's some really good, great opportunities there. And I think having a nice lakefront property is going to be key in a market like that. We also talked about, I think I'm on 4, urban market or like a university market. I would take a swing at around, I kind of said like a urban or college. I'll give you 2. How about that? I think you guys will accept that. Cincinnati, Ohio. Okay. I like Cincinnati a lot. I think there's some good opportunity there. And then finally, Oxford, Mississippi, Ole Miss. And I think that's a good university area. I've just seen really good numbers. That one's going to be a lot cheaper on purchase price. So I can afford something really, really cheap and then be able to reinvest into amenities, design, construction, anything I want. Like most of my funds are really just going to go towards, I mean, we're talking like 400 to 500 range now. So most of my funds can go into anything I want into that property to make it something special. Okay, Cincinnati, it's going to be a little bit less as well. And I can do kind of the same approach. And the urban markets, the properties are going to have to be even nicer. They're going to have to be more modern. They're going to be cleaner. The amenities, not as loaded as maybe some of the other vacation markets, but they are going to have some amenities. But it needs to be a really, really nice and updated property throughout the entire thing. Because the hard thing with urban markets is the moat. It's very difficult to get a moat in an urban market besides location. So I'm going to have to look for a property in a good location, number one, and then find one that I can make an update that's going to make sense. So that's how I'm going to approach that situation. And those are the 5 markets, or 5 plus 1, 6 markets I would be looking in, and the types of properties I'd be looking for if you gave me $250,000 to start looking today. Now, is that personally what I'm doing? No. Okay. My cash on hand and my budget and all is wildly different personally. I also have some personal preferences too. And we haven't really talked about that side of it, but that is really, really important. I don't think it's as easy as like go to those 5 or 6 markets, find a deal and move. I think you have to respect your personal preferences, but there also comes a point in time where your personal preferences might not align with reality. Okay. What I mean by that is we've had I know a few people who really want to be in certain markets, but those markets are just terrible short-term rental markets right now. And it's not that they're they're just bad. And they just don't cash flow and they don't make sense from a cash flow standpoint. And so I think some of this too is a little bit of reflection. Like if we're doing this for the investment purposes, let's focus in on markets that make sense financially, that cash flow, if that's what we're really trying to do. If we're trying to buy somewhere that we can go and visit once in a while or brag to our friends that we have, that's fine, but understand that that play is for appreciation and tax savings only. It is not for cash flow. So understanding your goals and aligning it with your personal preferences is critical to making a wise decision that you feel good about and you don't have buyer's remorse for. That's how I approach that. So hopefully you got a piece, a flavor, or a taste, not a flavor, a taste of how I think about approaching a search or a buy box search with, I'd use $250,000, but just in general, it doesn't have to be $250,000. You saw how I broke everything out there, but that's how I do it. And, yes, I understand I have all these different markets. And if you want to know some of the other markets out there too, I have a really good, if you go to strinsights.com and you go to, oh boy, I should have looked this up before I said it. So if you go to strinsights.com and there's a tab at the top that says data and tools, you click that tab, click top markets report. In that report, it's going to tell you the top markets for 2025 that I've personally hand selected based on budget. Guess what? $250,000 is one of them, but also 75, 150, and 200. And there are over 80 different markets in that list and my top 10 markets that include other markets I haven't even talked about on there as well. And so that's a really good place to start. It's free and it'll tell you some good markets. And then you can start seeing if it applies to your situation. And a lot of those markets will, okay? Because they're hand selected for a reason where we've seen actual deals and good numbers in. So check out that report. And that will help you get a good starting and a launching place to understand where to go. So that once again, let's go to strinsights.com and then go to the data and tools tab, and then click the top markets report. Put in your information, it'll send you the email with the report, and you can download it, and boom, there it is. So be sure to check that out, and that's a good place to start. So I hope you enjoyed this episode. On the next episode, I'm going to bring in somebody who's going to go through the situation themselves and tell you and break down how they think about finding markets and deals based on this random scenario of $250,000 to invest. I hope you enjoyed this episode, and I will see you on the next episode of Cash Flow Positive.